Let me just go ahead and record this while I'm at it.
Yeah.
All right, so universal life only applies. I mean, option A and option B is the death benefit options. So the client chooses them in the beginning when they get their policy, okay?
Okay.
So when the person dies, option A is called a level death benefit, which means that level death benefit, which means that they're just going to get whatever coverage they have. So for example, you see $100,000 in coverage. On
Yep.
option A, when they die, it's always going to be $100,000, even if the cash value grows to more than 100,000, they're only getting 100,000. So basically, in other words, you lose your savings if you die on option A. So
Oh,
you're
okay.
paying for two things, which is the face amount and the cash value, but you only get one, option A. Level, that's why it's called a level death benefit, because you only get the death benefit never changes. It's leveled 100%. Does that
Has this always been in effect, the option A and option B?
always, since they started doing this a long time ago?
And
Option
it's so
A
universal, right?
on Universal Life. Yeah, this is a ripoff, to be honest. Like people that sell Universal Life policies.
Uh-huh.
Option A, this is not on the test, right? Because it's just a product. But why would anybody get a level death benefit if you're paying for two things? You only get one. That's like buying a pair of shoes and you open up the box when you get home and there's only one shoe.
Hmm.
That's literally how option A works. You're buying a pair of shoes and you only get one shoe when you open up the box.
What's the point then?
Well, the point is that the insurance company makes profit.
But people usually go with option B, don't they?
No, people don't know any better. People are sold what the agent tells them to buy.
Right.
And most people buy option A because it's cheaper. Option B, you get both, but it's more expensive. So option B is called an increasing death benefit. All right. This is going to be on the test. So increasing means that it goes up. That means that you get both the face amount and the cash value.
Thanks.
So let's read it here, right? So it says, under option A, level death benefit, the death benefit remains level while the cash value gradually increases, therefore lowering the pure insurance with their insureds of later years. Notice that the pure insurance is actually increasing as time passes by, lowering the expenses and allowing the greater cash value and allowing for greater cash value in the later years. The reason that illustration shows an increase in death benefit at the later point of time is that so that the policy will comply with the statutory definition of life insurance that was established by the IRS applies to all life insurance contracts issued by 1984. According to the definition, there must be a specified corridor. All right, so this is good. When on the test you see the word corridor
Mm-hmm.
or gap, corridor or gap, they're
Mm-hmm.
referring to option A, not option B. So on the
Option
test,
A.
you might see something like, which of the following policies or which of the following death benefits allows for an IRS corridor or a gap? And the answer is option A. Or they might have the answer as level death benefit. These two are AKA, AKA, also known as synonyms. Got it?
Got it.
The percentage that applies to the corridor are established by the table published by the IRS and various ages. Da, 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 da. If the corridor is not maintained, the policy is no longer defined as a life insurance for tax purposes and consequently loses most of its tax advantages that have been associated with the life insurance. Because life insurance is tax-free death benefit.
Mm-hmm.
So, so basically there's a corridor here. This is not a really good chart right here, but uh the death benefit is always leveled, but if the cash value is more, you're only going to get 100,000 anyways because it's a level death. That's what level death benefit means. Option B is an increasing death benefit. And as you can see right here, let's read it together. The death benefit includes the annual increase in cash value. There it is. So it includes a cash value. So the death benefit gradually increases each year by the amount that the cash value increases. So if the death benefit is 100,000 and the cash value is 30,000, then the death benefit is 130,000 because
Because it
that's
adds to it.
because it's added to it. That's option B. Yeah.
There ain't no keywords to that one. Just it's just increasing death benefit.
Yeah, this one's straight up increasing death benefit. See, it says since the pure insurance with the insurer remains level for life, the expenses of this option are much greater. You see that? The
Mm-hmm.
expenses for this option are much greater than option A. So, in other words, the clients pay more for this benefit. There it is. It's in the black and white right there. So, option B is better, but they're going to pay more for it. So, they're
Right.
still going to get you.
Like anything in life, like if you buy Gain instead of the off-brand of laundry soap, you're gonna pay more for better products.
Exactly. Thereby causing the cash value to be lower in the older years. So, you see that? So, even though it's more expensive, the cash value is going to be less in the later years compared to option A. So they
Cool.
charge you more, but they take it away on the back end. That's it. So that's all you need to know on option A and option B. That it's a
Okay.
universal life.
It says right here what to focus on for the thing. So, um,
Is there option A or option B on whole life policies? The answer is no,
no, just universal, right?
just universal. So what are the different types of universals? Index universal, guaranteed universal, survivorship universal, variable universal. Okay. Anything that has a word universal, it has option A and option B.
It's flexible, right?
It's also known as flexible premium adjustable life. Okay. Look at this. Universal life is also known by the generic name of flexible premium adjustable life. It's there, black and white.
I have all that right here. Look, these are really good. And then it says, what was I gonna show you? The what is there different ones in different states? Let me see if I can find it. Just had a question mark by it. The replacement rules, are they different in different states?
Yeah, every state is different. What's the replacement rule in your state?
Hmm.
Indiana.
That's right. Right,
Hi, Peasley. If it has the word variable, what's going through your mind?
variable
Yep.
security license.
You need a securities license.
Mm-hmm. Cash
And what
value
else?
and separate cash value and separate
You
accounts.
put the cash value in a separate account. Good job.
And no guarantee returns, I guess. That's the only one.
No guarantees because the market could be positive or it could be negative. No guarantees.
Yeah, and immediate. I know annuities. See, our mandatory policy provisions, entire contract, insurance clause, free look is 10 days in Indiana, 30-day grace period, 3 years reinstatement, incontestability, 2 years.
Hmm.
Ours is different than yours.
Any questions?
No. Oh, then the notice of regarding replacement required. And then it said old insurer responds within 20 days. That's our rules.
Yeah, see that right there? I'm in California, so I have no
So
idea.
what do I need to look up the notice regarding replacement in Indiana? Or
Yeah,
is that
that
just a
that
piece of
one should
paper?
be pretty much the same that in any state because when you're replacing the policy, you have to add the notice regarding to replacement to the application
So that'll just
by
come with it.
law. So by law, you have to tell the other company, "Hey, I'm replacing your product, bro."
Yeah, and you got to tell the old insurer. Yeah, and they have 20 within 20 days to respond in
Yeah.
Indiana. So you have to contact the old insurer that they're with and let them know.
Yeah, which is crazy because like that's like you have a Honda, right? And a sales guy says, "Hey, you should get a Toyota." And when you're about to buy the Toyota, Toyota has to tell Honda, "Hey, I'm replacing your car." That's
Wow,
ridiculous.
that's
That's not,
crazy.
that's unconstitutional, but it's the law. And by the way, that law is only on life insurance policies.
What?
And it was created because of our company because we replace a lot of the trash
You know,
value.
they say the life insurance state exam is really hard. They say that. That's the rumor around town. I just don't want to get discouraged if I don't pass it. I just been
No, where
trying
are you
so
gonna get
hard.
discouraged?
I'm ready to start working, man.
I know, but
I know a lot more than I did though. That's this the exam FX is way
honestly, I
better.
think you're gonna pass it. I really don't see you failing. You know a lot of stuff, but even if you do fail, who cares? Let's take it again. Let's go.
Okay,
I'll
so let's go over what do you how much time you got? Guaranteed accidental. That's all the riders. Uh
so
Beneficiaries is revocable, is irrevocable. You have to have a written thing. Revocable, you can change it. Settlement options really is settlement options is the way you get your money back, right?
yeah.
Policy
Settlement
calculator.
options, how do you want your money back?
Yeah, you can do lump sum, interest only, life income, fixed period, fixed amount. I think.
Yeah, those are over here. So settlement options, I'll give them to you right here. Watch. They're there right there too, but I have a better way. I saw this one. This is really cool right here.
I've been watching your videos, man.
Look at this. Settlement options. Straight life is a settlement option. How does that one work? You remember?
That's like you get money forever, right?
Well, let me lock it right here. How do you lock? All right, settlement options, you get money forever. Exactly. And when you die,
Yeah,
what happens to the money?
because beneficiary.
Nope. Straight life, you lose it. On straight
Oh,
life, you
you
lose.
lose that on straight life?
Yeah.
Refund life
Refund life, you get payments until you get all your money back.
until
Or
the money runs out.
until the money runs out. A straight life, money never runs out. Even if the money runs out, they have to pay for it out of their pocket. Got it?
Got it.
Life period certain, how does that work?
Period of time. So if it's a 20 year, they die within 10, they get 10 years of the money left, right?
Exactly. But if
Yeah.
what if they live past 20 years? Do they still get payments?
No, they cancel.
No, that's the tricky part about this one, okay? On
Oh,
this
it's
one,
live.
yeah, it's life. So on
Life
on
is
life with period certain, they're gonna get it for the rest of their life, even if they pass the period certain of 20 years.
until the death benefit runs out, right? Or
No,
does it
this
ever?
one is even if the death benefit runs out, they still get money until the
That's what
person
people
dies.
should get that then. I'd want that.
Yeah, that is actually a good benefit. It's just that the reason people love straight life is because the payments are bigger than life with period certain. And so people think they're gonna live forever, so they get straight life because they overcompensate on that they're betting on a long life.
Yeah, we all are. We all want to live
We
forever,
all
dude.
are, yeah.
I know this lady that's 99, dude. 99.
Sheesh. Yeah.
Dude, I would just say, you know what? And she's like planning her funeral. I'm like, dude,
Uh,
what, it's so depressing to think about, bro.
no, what do you mean depressing? We're all gonna die. What are
I
you
mean,
talking about?
99, dude.
Hey, that's pretty good. I mean, if you're
That's
still
awesome.
if you're
I
able to
thought the only
still
Chinese lived that long, man. Not American.
good for her.
All right, single versus
How
multiple.
about how about joint life? How does that work?
Joint life is the first to die,
Joint and survivor?
second to die.
Come on, dude. You know this stuff. You're gonna pass it. Yeah, I think you're like
No, dude, I have
well
been
prepared.
studying off my butt, man. And then when you don't answer, I panic. Did you notice that? I was blowing your phone up. Fixed period is how are you gonna get your benefits? Fixed period is when I can't really remember this one. I gotta write it down
Come
again.
on, fixed period. What is it?
Period of time.
Fixed period is when the client says, I want my money for this period, this fixed period of time. Like let's say the client says, I want my money for 17 years.
So you gotta estimate it into 17 years, right? His benefit.
Yeah, so they're gonna get money for 17 years. Whether he's alive or dead, you know, they're
Fixed
gonna get
amount is the amount that you're gonna give. until it runs out.
until it runs out for that period of time.
I'm talking about fixed amount, right?
Oh, fixed amount? Yes. It's they get a certain amount of money until the money runs out. That's what you said, right?
Yeah, that's what I said. Okay, let's see here.
What is an immediate annuity since we're in the topic?
It's a lump sum. You get it within 12 months.
You get income within 12 months.
Deferred after 12
Good
months.
job. What is single premium annuity?
I don't know. That has to do with payments, but I don't really
It's
remember.
it's based on payment. So single premium means that the client just basically gave a huge payment to get his annuity payments. He just made a huge payment. Like
The
most of the
single
time, yeah, most of the time it's like a rollover. They worked, let's say they worked at Marriott for 30 years. They accumulated $300,000 and now they retire. So they're gonna put that $300,000 into a single payment into an annuity.
level is like a little bit higher, right? I mean, in between.
Level is just it just means that they're starting an annuity with from scratch and they're making payments of like let's say $500 a month or whatever.
And it never changes.
What do you mean?
It's always level, right?
Oh yeah, the payment is leveled. Yeah. The payment never changes, right? And flexible is just, sporadic amounts of monthly payments.
Yeah, it changes. It's flexible. That means it
All
changes.
right, how about this? What is a fixed annuity? Where'd it go?
Fixed annuity. How they're invested. Something. But I gotta see what a fixed annuity is.
Fixed annuity is how it's invested. It's invested with a fixed rate of return. Does that make sense?
I know the equal index one. It's in stocks. 500 SP 500. That's what you
Yeah.
got to remember. Variable annuities, you got to have security license to even sell them. So I won't even be selling those.
Yeah. Keep it
Fixed
simple.
annuity is where your payments are going to be invested, right? But it's fixed is when,
Fixed is basically keep it simple. Fixed is when you're getting a fixed rate of return, a fixed monthly payment. Okay. Does that make sense?
what do you mean?
Well, yeah, the rate of return. So let's say the money's growing, the
Hmm.
money's invested in a place where it's going to get a fixed return like 3% guaranteed, fixed.
So it's
That,
guaranteed.
huh?
It's guaranteed.
Yeah, it's guaranteed. So a fixed annuity is a guaranteed interest rate. Variable annuity is that it's invested in the stock market, it's risky, separate account, you need a securities license. Remember that?
Yep.
So
We
that's
won't be
variable.
selling them. We got to know it, even though we won't be selling them.
Yeah, yeah, exactly. Equity index annuities, what is that?
Stock market, invest in the SP 500.
Yes, S&P 500. So it mirrors the stock market, but it's not in the stock market or also be a variable product. So do you need a securities license to put your money in an equity index annuity to help clients do that? No.
No, no, just variable.
Yeah. Annuity, look at this. This is good right here. Let me lock this.
Accumulations, money in,
Yeah,
the money out.
accumulation, money in, annuitization, money out. And that's pretty much it. That's all you need to know about annuities. I mean, it's pretty simple. I think you got it all. You have
Yeah, I've been studying.
you have settlement options, you got how the money's invested, when do payments begin, and how do you make payments? Everything is in the screenshot right here.
Okay, let's see.
How about let's talk about dividends. What do you know about dividends?
They're not guaranteed.
Dividends are not guaranteed. What else?
There's different dividend options. I know.
Oh gosh, how come it keeps doing that?
Paid up edition.
Dividends are not guaranteed. What is a dividend?
It's policyholders?
Nope, right here. Look at what it says right here.
Oh, it's the refund of, no, it's the refund of the premium, right?
But it's not just premiums, it's an overpayment of premiums. You got to get the wording right.
So you don't get that back
Well,
all the
it's
time.
not guaranteed. You might get it back.
Why is it not guaranteed if you overpaid?
Rip off. It's a way of making money. It's a profit. It's a profit generator. It's a rip off. Honestly, they take advantage of people by telling them our policies pay dividends. That's actually a rip off statement. Crazy, huh? And it's on the
That's
test.
insane.
Yeah, it's real. So all these, what kind of companies pay dividends? What are
Mutual,
they?
mutual.
They're called mutual companies. All right. So anything that says mutual, basically they overcharge people because they have to overcharge them to give them a refund of overpayment of premiums. So, so mutual companies pay dividends to policyholders as opposed to a stock company. Like my company, Primerica, we're a stock company. So the
Shareholder.
so the company pays dividends to shareholders, and these two dividends are totally different. Dividends to policyholders are a refund of overpayment of premiums, and they're not guaranteed. And dividends to shareholders are also not guaranteed, but they're not a refund of overpayment. They're actually profits. But you don't have to know that on the test. You just have to know that a mutual company. Also, what kind of policies pay dividends? Participating policies
Mm-hmm.
versus non-participating policies. So our company, Primerica, we're a stock company, right? We're part of the New York Stock Exchange, ticker symbol PRI. That so we have non-participating policies. Does that make sense?
Non-participant is Primerica
Yeah,
as
we're
well.
not. Yeah, exactly. So let's look at the test here. Let's see what we got here. Dividends. Where would dividends be at? Let me see. It would be in the individual life insurance contract, maybe. Let's check it
Yeah,
out.
right there, dividend options, right?
Where?
E.
Oh, there it is. Yeah, here it is. All right, let's zoom it in. All right. Dividend options. So it says right here, dividends are paid only to participating policies. When purchasing a policy, participating share the policy owner has pay grossed up premium. The higher the premium is charged, a safer margin of the see margin right here, profit margin.
Mm-hmm.
In the event the insurer loses, the higher than anticipated. So the higher the premiums, the more profit margin in case the insurance company loses money. So they make it up from the client. Crazy, it's
Mm.
here in black and white.
What?
It says right here, if the extra money that was charged to the client is not needed by the insurer to pay the death claim and expenses or mortality expenses, I mean, look at all the expenses, man. They just charge people so that they could make sure that they make a profit. A dividend will be returned to the policyholder. In other words, dividends are a return of excess premiums. Crazy.
That's insane.
And for that reason, they're not taxable. So are dividends taxable?
No.
No, I forgot to put that here. I should type it up right here. It's good. So I'm gonna put it right here actually. Dividends are not taxable. They're not taxable. Why? Well, because they're just refunding you back the money that you paid.
Even if you even get it.
If you even get it, exactly. That's so crazy.
That's insane, dude.
That's real. And that's part of what we do. You know, we educate people about this because people don't know, don't know any better. And that's what you're going to be doing, helping people get informed. And that's good that you know it that well, Peasley. So tomorrow you're
Mhm.
going to pass it. I
Dude, I'm so nervous, man. I'm not even gonna
I
lie.
I have a super strong feeling you're gonna pass it because you could tell you've
So,
been studying.
yeah, I've been studying. But I'm saying, and even if I don't, it'll tell me what I need to work on. That'd be good.
Well, we're literally doing it, so
All
you're
right, what
learning.
is risk management?
Hold
Void.
on, hold on, hold on. Before we go into that, like write it down. Don't forget, okay? So it says dividends are not taxable and cannot guarantee. So and they're not guaranteed. We already went over that, right?
Mm-hmm.
Um, Dividend options, right? What do you do once you if you do get a dividend, you could get it in cash. You could use it to reduce your premiums, which duh, if I'm paying extra, you better reduce my premiums, you know,
Yeah,
but if you don't get it, then you got to pay the full premium still. Accumulation at interest. So you could basically put it in an account where it's getting dividends. I mean, getting interest on the dividends that you got. So if you do get interest on on this account, you're gonna have to pay taxes. The dividends are not taxable, but the interest is taxable. Does that make sense?
yeah,
Number four is paid up additions. That means you could get a policy that it increases your death benefit and you're basically buying a policy that's paid up. So that means to age what? What anything that says paid up is what?
100.
To age 100. Good job. Number five is 1 year term. So basically you get those dividends and you buy a 1 year term policy. So you basically get more coverage for just 1 year and then it goes back to normal. Got it?
Yeah, it's term. Yeah, that's temporary.
So they're right here. Cash out, reduction of premiums, interest, paid up additions, and 1 year term.
Cool. So,
What was your question now?
risk management. We just gotta know avoid, reduce, retain, transfer.
Yeah. So
So,
redu let's go. Let's check off the easy ones. Reduction, risk management. Where would that be at? What chapter is that on?
it should be in the general concepts, first one.
Basic insurance concepts and principles. Risk. Where is it? Risk
It's
management techniques. Here it is.
there.
All right. Risk management. Sharing. Sharing um is like group insurance. See that? Should just when you hear sharing, think of group insurance because you're sharing the risk by a big group of people. So it's like group insurance. That's why group insurance is cheaper. Sometimes it's free. Get it?
Yep.
Because it's you're sharing the risk with a group of people. Transfer of risk. How do you transfer risk? Well, you just buy insurance, right? Insurance is the most common method of transferring risk. So in fact, in the test is going to say insurance is the what? What's the definition of insurance? Insurance is the transfer of risk. Alrighty? Transfer of risk. So basically right here is talking about how do you manage risk, right?
Right.
So there's you could avoid it, you could retain it, you could share it, or you could reduce it or transfer it. So we just went over transfer of risk.
Yeah,
We
buy
went
into
over sharing right now, which is
group.
group insurance. Number three is avoidance. Avoiding means like for example, if you drive, is there a risk of you crashing? Yes or no?
Yeah,
Yeah, it could happen, it could not happen. So avoidance means you're straight up not going to drive. You're avoiding the risk. Get it?
got it.
So you just use common sense. It's like literally you're avoiding the thing that is going to cause you to have an accident. So if you don't want to be in a plane crash, Avoidance means you're straight up never gonna fly.
Right. You're gonna avoid the whole situation.
Yeah. Retention. Retention, you reduce the risk of losing money. You retain the risk by co-payments, self-insurance, deductibles. So let me give you an example. An insurance company, if you get in a car accident, and let's say the car accident is $3,000, it's gonna cost. But there's $1,000 deductible, so therefore the insurance company retained $1,000, and they're only gonna pay 2,000 instead of 3,000. Get it?
Hmm.
So they retained part of their loss through deductibles, co-payments, self-insurance. And then reduction is literally what it says. You, like, for example, um, if you don't want to die in a car accident, put on your seatbelt. By putting on your seatbelt, you could still die, but you're going to reduce the risk of death. You don't want people to rob you, put on cameras, put on deadbolt locks. That's because you can still get robbed, but it's going to reduce the risk of you getting robbed because they're going to look at the camera, they're going to look at the deadbolt, and they're going to be like, let's go to the next one. Get
Right,
it?
I got it. Yeah.
That's how that works. Sonia, podemos tener la cita mañana, así puedes tener más tiempo para ayudarte a él. Mañana, en la mañana está bien a las 10 de la mañana. Let's see. Mañana, Sonia, no puedo a las 10 de la mañana. Sorry, Paisley, give me one second.
I know what you're saying. Just don't you don't think I do.
You speak Spanish?
No, man. I just tell people that's them. Be talking shit. Yeah.
You're s- you're hilarious. Um, a las 11 de la mañana. A ver, espérate.
Is she new?
Yeah, she's studying for her exam too, Sonia. She's joining us, but she speaks mostly Spanish than English. Let's see. So she's taking her, I think she's taking her test in Spanish, right, Sonia? Oh, look at that. Sonia, you're in the meeting
Yeah.
because I'm literally studying with her, supposed to study with her now, Peasley. Sonia.
Yeah, she's in here. She's been in here, dude. You didn't see her?
So, mañana está bien a las 11.
Sí, está bien.
Ok, me conecto al mismo link.
Sí,
Hmm.
Sonia, disculpa. No, hay que estudiar de una vez. ¿Tienes tiempo ahorita o no?
No, no voy a tener tiempo.
Sí, a la misma link mañana
Ujú.
a las 11:15. ¿Qué te parece?
Ok, ok.
¿Sale? Ok,
Ujú.
thank you, Sonia. Bye bye.
Ok, gracias, bye.
Gracias. Gracias, bye.
Bye.
I rather
Yeah,
speak Spanish than English.
yeah, she logged in because we actually were scheduled to study right now. But I
Oh
told her,
man,
but
I'm
she
about
said I
to
gotta
take
go
the
anyways. So we just rescheduled for tomorrow at 11:15.
okay, cool. I'm
It's
about
all
to take the
good.
practice exam.
Huh?
I'm about to take the practice practice exam without the chat GPT
Yeah. Yeah, you gotta
and
do
see
that.
where and then you can do it exam mode or you can do it learning mode.
Do learning mode because you still get the right score, but you're learning on the way while doing that. So you don't waste time. You're still learning.
Cool.
Take that exam, Peasley. That's important.
I am taking it.
What else? Any other question?
Uh, really, I'll call you back if I have any more questions. Trust me.
All right, no problem. Hit me up. I'm actually available tonight. I have a training at 8 p.m. my time.
Hmm.
So if you want to call me
Oh, I was
before
gonna
that,
ask you, do we get our own leads or do you give us leads at first to help us out?
um, the the leads question. I'm not gonna give you leads because that's if you give a man a fish, then he'll eat for the day. But if you teach him how to fish, he'll eat for a lifetime. We're gonna teach you how to fish. Does that make sense?
Cool. Yeah, yeah.
So learning how to fish takes a little bit of time, but eventually you're gonna be able to catch a bunch of fish on your own and not
Dude, I
depend
love
on
that.
anybody.
I
Those
love that.
companies that tell you I'm gonna give you leads, I'm gonna sell you leads, really they're not really good leads. It's actually a bunch of BS because if I had, let's say I had leads,
Uh-huh.
I wouldn't sell them to you so that you could close it. If you're gonna,
Right.
I wouldn't sell them
Nobody
to you for
would.
like $200 if you're gonna make 1,000. I would like to make 1,000. I'm willing to work. I'm a hustler. All right. I'm a hard worker, so I'll close
Yeah,
the deal.
nobody would do that. Nobody.
Exactly. So
In
anybody that
America.
tells you, "Hey, we provide leads," that's a bunch of BS. It's just a tactic to attract the lazy. Does that make sense?
Yeah, it's just there's always a twist and turn to something. You gotta know
Yeah.
that.
So really the best coaches are the ones that are going to teach you how to be a coach.
Right. I
That's
love to learn, dude. I do. And I like learning from older people that have lived longer than me. I think it's so stupid to argue with somebody that's lived longer. Like if you was